Grains are lower on Friday after the WSDA report. Ellen Brugler, Brugler Marketing, joining us. And Ellen, let's talk about corn. First off, we did see a yield cut. Production and ending stocks also cut, but yet we ended lower. Some of that due to FSA acreage numbers that came out too, right?
Yeah, I think the market's still trying to process those. With the planted acres for FSA for corn were over 93 million, which is an unusually high percentage of the NAS number for this early for August. NAS won't officially adopt the FSA or what they call administrative data until September, but they would have had access to those numbers ahead of the report. And when the market broke right when the FSA report came out, so I think the fear is that there might be a few more final acres than what NAS was using today.
Yeah, and soybean yield cuts were a bit bigger than expected as well. Yet the market kind of faded those. Why?
Yeah, I think part of it's the ending stocks. You saw them raise the old crop ending stocks by 5 million bushels. The new crop ending stocks were down 60 million year versus the July report, but the trade had been looking for a bigger cut than that, given the size of the production cut. USDA cut exports for corn, beans, and wheat, and that's, I think, a real concern here. We can have tighter supplies, but if we're losing market share for either other countries or just due to global slowdowns, maybe the price level is still not right.
So let me ask you, we took these surveys and there was a lot of good rains maybe after some of these surveys were taken. So do you think that the trade believes that yields are going to get better going forward and USDA may have to revise and go the other way?
I think that is a fairly common theme, particularly on the bean side. People are a little more ambivalent about corn. Was it hurt enough early that it doesn't really gain much here other than maybe a little test weight? The beans are a crop of August. We all know that, I think, and have shown that statistically, that if it rains in August, it does tend to help bean yields, unless, of course, it's excessive. I mean, you get 6 or 7 inches, you start to see a negative impact. But the story in beans is, yes, this is probably the lowest number you're going to see, unless we get an early freeze or you get another derecho or some event that isn't currently on the horizon here.
What about corn? Do you think yield is going down there? And even if it isn't, are we going to see some of the yield cuts if we get them offset by lower demand? Is it just going to be that dance continuing?
We're in a price rationing situation to a degree. That's why the exports are down. You have to remember, even though corn prices have dropped, they're still well above the 5-year average price. And there's producers all around the world that say, oh, corn's $5, I can grow it for that. So we're still in that short crop, long tail mentality of trying to right size production and the disappearance. Basically, USDA saying Brazil's still eating our lunch on export sales. We're starting to see the end of that in soybeans. China and other buyers are starting to step up finally on the soybean side. Brazil is running out. Argentina's clear out for all practical purposes. Corn, though, we've got that overhang of that record second crop Brazilian production that's probably going to still be with us in October and maybe even November and nicking our exports. So, that's a concern. Relative to yield, we may or may not have seen the low number on yield here on corn. There's a lot of discovery to be done yet, actually going out in the fields and looking at the ear lengths and, if you got seconds, are they going to make it? Are they going to abort? And that type of thing. We've got crop tours right now trying to get that ground truth to go with what all the remote sensing is telling us.
Yeah, we would need some pretty big yield cuts, though, on corn to overcome or offset the lower demand. And so are we kind of stuck in this above 2 billion bushel mark? And if we are, it's pretty hard to stay above $5 on corn, isn't it?
I think that's the risk. Over 2 billion bushels, if you look back at the long tail from 2014 to 2018, you were over 2 billion bushel carry out every year, and you basically were trading a $3 to $4.50 kind of a price range. We do have a little inflation, and the dollar's come down at least since last September, so maybe you don't have to go to 3 or 350 for a low. But and certainly you probably wouldn't do that this fall. We're still coming down off the mountain, if you will. But we did take out the September contract, took out the summer low today. December went down and tested the summer low. We're kind of at a key technical point here. And if you look at the long-term charts on corn, if you can't hold here, there is still 40 or 50 cents downside risk into next year, certainly.
Yeah, I know we've talked about that 481 July low on December corn for a while having to hold. What about soybeans? We've held the 100-day moving average and whatnot, but 245 million bushel ending stocks figure, does that translate to $13 beans?
Well, again, you got to look at spot futures versus the average for the year. USDA did raise their average cash price for the year by 30 cents today, just with that small cut in the ending stocks for new crop. So our models basically say they may still be low on their cash price estimate for the year at 1270. That is not consistent with the stocks usage ratio that we're looking at right now for the full year. But futures are trying to find a fall low. We're not as low as we were earlier in the summer here. So we've had a little bit of a rally, and that's subject to debate whether, if the yields are going to go back up, if we need to go back and retest those lows like we're trying to do on the corn.
Yeah, no doubt. So wheat ending stocks raised 23 million bushels, but you think the global numbers, export numbers especially, are a little bit more important, right?
Yeah. Well, the U.S. cash average price for the year does tend to reflect the global stocks use ratio and the U.S. stocks use, which is still getting tighter. I think the interesting thing out of this report for wheat is USDA cut the new crop exports by 25 million. They left the Ukrainian exports unchanged. They raised the Ukraine production, but they left the exports unchanged, despite the fact the grain corridor closed in July. So they're basically saying we're not sure if Ukraine's going to find other ways to get that wheat out of the country or not. The presumption would be if Ukraine cannot export and or Russia cannot export because of the conflict in the Black Sea, that the EU and the US might pick up some more business. But at the moment, everybody's taking a wait and see attitude. The Russians are still exporting and Ukraine isn't. And if you look at the weekly export sales, USDA just isn't getting the business here yet. So we have to be conservative. I looked at the prices. SRW prices are competitive with the Russians on an FOB basis. It's just the freight differentials that determine who can buy it.
Yeah, demand has been a real problem here for that wheat market for a while. Okay, cotton. A report today, we did see lower production and ending stocks, right?
Yeah, it was fundamentally a very bullish report. It was anticipated that it would be bullish. The crop problems in Texas with the record or near record heat and the previous dryness down there. Definitely the trade was looking for a smaller production number, and we did get one. It was probably a bigger cut than some of the traders anticipated, 2.5 million bales. But again, there's a trade-off there. If you have less supply available, you tend to have a higher price, and you tend to have some demand rationing. And USDA cut 1.25 million bales from the export total because of the reduced supply that they now expect the U.S. is going to have.
You bet. And cotton had a nice day as a result and reaction. And let's finally talk about the cattle market. We were down here today, even feeders, despite the pullback in the corn market. And so is this a healthy correction, or what is happening in this market?
Yeah, I think it's healthy. Cattle have been rallying and trying to go back to the old highs. We've still got pretty good fundamental news as far as the cash cattle trade. Had some pretty good numbers earlier in the week. I think the sell-off on Friday, I don't want to read too much into it. I think it's mostly profit taking ahead of the weekend. Sure. Traders are if they've got profits made in any of these commodities, are a little more prone than usual, I think, to cashing out ahead of the weekend. They're very nervous about overseas developments over the weekend, and just don't want to risk if they've got good money made. So I think part of the cattle weakness today was just profit taking. The feeders were down a little bit because of the fats being down, but I think benefited from, of course, from the corn being weaker.
Yeah, and it's been a real difficult to get a read on cash trades. So you don't get any real good direction from that either, do you?
Well, the problem with cash trade is it's split. Okay,
Yeah.
you've got one set of numbers in the north and a totally different set of numbers in the south. The board has tended to gravitate towards the southern numbers because of delivery risk, and we are in August. And if the board gets above cash too far, you will get deliveries. So you do kind of have to keep the numbers close.
Yeah, no doubt. All right. Thanks for joining us, Alan Brugler with Brugler Marketing. That's Markets Now.